Well, hey everyone. So I worked through problem number 4 from chapter 4 for the homework, like we talked about, and so I put together this just kind of this short little tutorial on how to do it. And the good news is, like when we talked in class, it looked like the book or Connect made a mistake in that when it was talking about, hey, up here it says that they bought it for 111,000, and then down here it says 111.5. And so what I didn't think about during class was both of these numbers are actually correct. And so the reason they're correct is this 111 right here, that's what they paid for it on January 1st. We're down in our trial balance. This is the trial balance as of the end of the year. And so what that's saying is that the investment actually only went up by $500. So it's just unfortunate that the numbers are so close. Most of the problems that we do, there's a lot bigger difference. So anyways, let's just walk through this problem, and it does have a couple wrinkles that make it a little bit more difficult. So the way the problem, so we have the problematic connect here with information, we have our trial balance, and so let's just pull out the information that we need, just to make it easier to see. So we bought 100% of it, and the purchase price was $111,000. And then it also tells us that the buildings and equipment fair value was $16,000 higher than book. So the excess was $16,000. And then also says we have a 10-year life on that. And then it also says that goodwill was impaired. So at the end of the year, the balance was $2,200. So we still don't know quite what we paid for it to begin with, but at least we know the ending balance now. So in this problem, I don't believe that Connect is actually asking for the equity method journal entries, but let's go ahead and do them anyway, just to make it easier to see what we're actually doing here. So in this box over here, we have the equity method journal entries, and so the first thing we always do is record the actual acquisition. And so that is going to be this 111. Then we record our income in the sub, and so we don't know exactly what that is. So they show 22.6 here, but we know there's going to be some additional amortization that lowers this number. So we want the actual, just the straight net income from the subsidiary. So let's go ahead and calculate that. And so the sales for the sub are $187,000. Then we have cost of goods sold at $120,000. We have wage expense at $18,000. Depreciation at $9,000. Interest expense at $4,000, and then other expenses at $5,000. So Roller Company's full net income is going to be $31,000. And so that's what we're going to book in our equity method journal entry to start with. Now the next thing we do is we show the dividends. And so the dividends were $22,100. We own 100%, so we book all of it. And so now we have to, it tells us that we have a difference between fair value and book value. So anytime it says that, we almost always will have to amortize. The only thing we have to check for is, hey, is that difference related to either an amortizable asset, a depreciable asset, or is there impairment? And so the first thing we'll do, so we have the excess value of PP&E of $16,000, and the useful life is 10 years. So we just take our $16,000 and divide it by our 10 years to get our amortization of that excess buildings and equipment. And then the one additional thing we have to do is, so it says right here, hey, goodwill is not amortized, but there is impairment. And so we need to actually go ahead and reduce goodwill here. But we don't know how much it is. We know the ending value of goodwill, but we don't know what that adjustment is. So let's jump over and do our little boxes where we have our beginning value and our ending value. And so we'll start by putting in what we bought it for, and then we're going to allocate this $111,000 between our book value, our excess, and our goodwill. And so the book value, let's go back over here. And so the book value is just the sum of the equity. And so they have common stock at 53, retained earnings at 33. So let's go ahead and add that up. So we have 86,000 of book value. It told us that our excess of identifiable assets was 16,000. And then so to figure out goodwill, we just take our purchase price and subtract out what we've identified. So that's going to give us a goodwill of $9,000. All right, while we're here, let's just go ahead and finish the ending value as well. So the book value is just going to be what we started with. We're going to add our net income, which was $31,000, and then subtract out the dividends, which was $22,100, I believe. So we have book value ending of $94,900. Now our identifiable excess, we started with 16 and then we amortized $1,600 away. So we have an ending excess of $14,400. And then goodwill usually doesn't change, but in this case they said it was impaired, and they said it was impaired down to $2,200. So let's go ahead and sum that up. Whoops. And so here we see, hey, the book told us that we bought 111. Our trial balance said it was 111,500. So we hey, both those numbers are correct. Connect didn't make a mistake. So that's always nice. Okay, let's go back to our equity method journal entry. And so we determined back here that goodwill was $9,000. So we need to book the adjustment here. So we had 9,000 and it got reduced to 2,200. So we have to adjust goodwill, and in the equity method journal entries, that's an adjustment to income and an adjustment to the investment in the subsidiary of 6,800. So okay, the book didn't ask for any of that, but I think there's a lot of important calculations that we have to do here in order to get our consolidation journal entries down here. So okay, so for the consolidation journal entries, let's do our basic journal entry, which first we reduce out our beginning equity of the subsidiary. So common stock is going to be 53,000, retained earnings is 33,000, and our income from the subsidiary we calculated at 31,000. Then we go ahead and subtract out our dividends, and so that is 22,100, and then we need to take out the book value of the investment, and so we calculated that over here at 94,900. Now let's make sure that our journal entry balances, so we'll add up our debits and we'll subtract our credits, and so good. Okay, our journal entry balances, good news. So the next consolidated journal entry is the amortization of the excess. And so the first thing we do is we want to book our depreciation expense, which we calculated up here. Then we have our goodwill impairment loss, which we calculated right here. And we offset that against our income from subsidiary. So 8,400. All right, and so The next we have to allocate the excess. And so it told us that we had an excess value of buildings equipment of 16,000. We have goodwill with 2,200. Accumulated depreciation is our 1,600. And the difference is going to be allocated to our investment in the subsidiary. And so the goal of this consolidation journal entry is to go ahead and remove that investment in the subsidiary. And so if we look at the trial balance, we had an ending balance of 111,500. And so the journal entries that we've done so far, we did the 94 and the 16.6, and so that adds up to 11,500. So we fully eliminated our investment account. So the last little bit is to our optional journal entry, which is to get rid of the accumulated depreciation as of the day that we bought it. It doesn't flat out tell us what that is, but we can calculate that. And so we had an ending accumulated depreciation of 34,000, and we have depreciation expense for the year of 9,000. So we just do 34,000 minus 9,000 gets us to our elimination of the accumulated depreciation as of the day that we bought the investment. So anyway, so I hope that was helpful. It's always nice to know that the book didn't make a mistake and make our lives harder. And so anyway, if you guys look this and have more questions, you guys can either shoot me an email or we can talk about it more in class on Wednesday. So well, good luck studying, and I'll see everyone on Wednesday. Thanks.